if you are coming under the large multinational enterprise groups under the OECD guidelines, you have to pay at least 15% in each jurisdiction in which you operate. Over 140 countries have implemented this OECD, or which is known as the global minimum tax measure. What exactly the top-up tax means? The impact assessments are essential. So business should ensure where they are standing, which includes subsidiaries, joint ventures, branches. This decision also excludes certain entities. Hello everyone and welcome to Alchemist Accounting. I am Muhammad Jawad, an assistant tax manager, and I am delighted to join you for discussion on the major tax update in the UAE. This is as part of our ongoing effort to keep you informed. This is like a new top-up tax under the Decision No. 142 of 2024, a significant reform that is applicable on the multinational enterprises on their global level profits, which is 15%. So this is a measure adopted by the UAE to align with international standards, strengthen its reputation. So if you're having business across multiple borders or multiple jurisdictions, this is very important to understand. Let's start with the bigger picture now. So over 140 countries have implemented this OECD, or which is known as the global minimum tax measure. Like the large multinational enterprises should pay at least 15% tax on their profits, regardless of whether they are earned in here or there or in another jurisdiction. We have to pay 15% tax. This measure adopted by the UAE for the matching or the international cooperation or the transparency between the multiple countries under the OECD. So it's 140 countries including UAE have adopted this measure. So it's a clear signal to investors or the multinational organizations to be serious about compliance, even though the business or the UAE business remains attractive or an attractive business hub. Now we will check on who is exactly affected by this decision. So this decision is applicable particularly for the large multinational enterprise groups or MNEs which have consolidated annual revenue of at least 750 million euros in 2 of the last 4 fiscal years. So in simpler words, this is applicable on the large multinational groups. Even maybe they are applicable for the CBCR reporting under the OECD. So it's worth noting that every constituencies in the UAE which are coming under the multinational groups, which include subsidiaries, joint ventures, branches, and even stateless entities are coming under this rule. So small or purely domestic entities or medium entities are not applicable by this decision. This decision also excludes certain entities like government entities, non-profit organizations, sovereign wealth funds, and other real estate investment vehicle which is purely qualifying under this rule. So the new framework is focused precisely on the large multinational groups where the global tax coordination is essential. So let's take a moment to simplify what exactly the top-up tax means. So if you are having a business in the UAE, as you are aware, standard corporate tax rate is 9%, which continues to apply. So however, if you are coming under the large multinational enterprise groups under the OECD guidelines, you have to pay at least 15% in each jurisdiction in which you operate. So if your effective tax rate is below 15%, after adjusting all covered taxes, you have to pay the taxes to bring it to the 15% minimum. So for example, if you're having business which you pay 9% effective tax rate, you have to pay 6% extra to bring to the 15% minimum. For example, another example we can take is if you are a qualifying free zone company who is taking the benefit of exemption, there we are having 0 rated. So you have to pay 15% to bring to the minimum, even though we are waiting for some additional clarifications or guidelines from the FTA, maybe in the form of refundable credits, which we can match with the 15% tax deductibility or tax percentage. So to brief about or summarize, we can say that UAE is ensuring the tax is collected appropriately, not moving the tax to the other jurisdiction, preventing harmful tax practices or eliminating double taxation. Now we can check on the calculation part. So under the OECD guidelines and the UAE global framework. It is following a structured approach which comprises of mainly 3 steps. First of all, like calculation of Pillar Two income or loss, then the computation of adjusted covered taxes, then comes the ETR calculation. So to begin with, like Pillar Two income or loss, it's basically starting with the financial accounting income or loss. Then we have to adjust certain items like exclude dividend, equity gains, some income and expenses where there is a timing differences, and that's it for the like financial or the Pillar Two income or loss. And when it comes to the step 2, adjusted covered taxes, it's basically the taxes which we actually paid or accrued adjusted with the deferred tax under the UAE tax law. Then comes the step 3 where we have to compute the ETR, which is effective tax rate, which is basically adjusted covered taxes divided by the Pillar Two income or loss. So if the ETR is below 15% or the difference between the ETR and the top-up tax, it is also known as top-up tax percentage, is often applied to the global profits, excess profits, then we will arrive at the global taxable amount. So this might sound complex for you, but we can help you out with the detailed computation and the calculations. So when we look into the UAE's implementation framework, what the most important or advantage feature we can see, they promote the real economic substance. So when it comes to the top-up tax, they are giving a deduction in the form of economic substance deduction, which is basically like if you have a genuine operations in the UAE, you can benefit from the top-up tax exposure. To simplify or give you an example or actual rule, they are giving a 5% benefit on the payroll cost, eligible payroll cost, and the 5% on tangible assets from the income subjected to the top-up tax. So it's like a promotion or rewarding the actual assets, employees and business in the UAE. So like aligning with the real economic substance with the taxation. When come to the compliance standpoint, every UAE entity which are part of multinational groups have to file top-up return and information return with the UAE Ministry of Finance. These rules are also allow a designated filing entity, which means one entity which can file on behalf of others of the same group. So the due dates are basically after the end of financial year, which is 18 months for the first transition year, which is followed by 15 months in the subsequent years. So while the UAE Minister of Finance releases more guidance on the formats, UAE's business must be reviewing their internal systems, accounting practices, and data management systems to ensure their readiness. So beyond the compliance point of top-up tax, there is strategic implications by top-up tax is addressing, like the groups must ensure what is the effective top tax rates, what is the intercompany arrangements, what are the transfer policies in effect, so which we need to align with the top-up tax guidelines. So even the finance and tax need to recheck their deferred tax accounting treatment, then the profit allocation, cash flows, everything need to be rechecked again. So early impact assessments are essential. So business should ensure where they are standing, what adjustments should be made. So if they are ready earlier, they will have clear advantage over the others. So at Alchemist Accounting, we closely follow the OECD Pillar Two developments and the UAE implementation framework. We are already advising the clients on readiness assessments, like potential top-up tax exposures, integrating compliance requirements with the existing tax reporting system. So our approach is proactive rather than reactive, and we are giving the business a clarity, confidence and compliance before the first reporting cycle begins. To summarize, the UAE's new top-up tax under the Cabinet Decision No.142 of 2024 is a landmark reforms that aligning with the global tax movement. So it's not just a technical change, it's like a UAE's global evolution to the integrating or transparent, like a respected business jurisdiction. So for the large multinational enterprises, it's the time to prepare by understanding how the rules will apply, review the structures and plan strategically to be aligned with the new corporate top-up tax rules. If you would like to know how this reform affect your group of business, or you want to draft some specific compliance strategy, our team at Alchemist Accounting would be happy to assist. Thank you for watching, and don't forget to follow Alchemist Accounting for further updates on the UAE corporate tax and the OECD Pillar 2 guidelines. Thank you.